8.2 Income tax and social security tax. Income tax are paid on personal incomes and corporate profits. The personal income tax. The amount of income tax that a person pays depends on her or his taxable income, which equals total income minus a personal exemption and a standard deduction or other allowable deductions. The personal income tax equals total income minus personal exemption and a standard deduction. Personal exemption is exemption or portion of your personal or family income that are exempt from taxation. Both dependent and personal exemption lower the amount of your taxable income and ultimately reduces the amount of total tax you owe for the year. For example, in 2017, the personal exemption is $4,050. It's the same amount for your spouse and each dependent as well. Example, Josh and Kristen are married with a combined income of $90,000. They have 3 children whom they claim as dependents. That means they can claim 5 exemptions of $4,050 each. That reduces their taxable income by $20,250. Standard deduction. Standard deduction reduces taxpayers' taxable income. It ensures that only households with income above certain thresholds will owe any income tax. In addition to the regular standard deduction, taxpayers can claim an additional deduction if they or their spouse are 65 or older or blind. The standard deduction amount in 2020 is $12,400 for single filers, $24,800 for married couples, and $18,650 for heads of households. The additional deduction for those 65 or over or blind is $1,300. Couples and singles with income below those amounts owe any income tax. For the federal income tax in 2013, the personal exemption was $3,900 and the standard deduction was $6,100 for a single person. So for a single person, taxable income equals total income minus $10,000. The tax rate depends on the income level and the figure shows how the tax rate for a single person increases with income. The percentages in the table are marginal tax rates. In the figure, the marginal tax rate increases with income. The table provides the data for a single person in 2013. The average tax rate increases with income, but the average rate is less than the marginal rate. The marginal tax rate is a percentage of additional dollar of income that is paid in tax. The marginal tax rate is the amount of additional tax paid for every additional dollar earned as income. A 10% marginal tax rate means that 10 cents of every next dollar earned would be taken as tax. For example, if taxable income increases from $8,924 to $8,925, the tax paid on the additional dollar is 10 cents and the marginal tax rate is 10%. The average tax rate is the total tax paid divided by total income earned, the percentage of income that is paid in tax. Because of the US progressive tax system, people pay different percentages of tax the higher their income gets. The average tax rate helps them figure out how much tax was paid overall. The average tax rate is less than marginal tax rate. Taxpayers pay less in lower income brackets, more in higher brackets, which is called marginal tax rate. Every dollar they earn above their current bracket is taxed at the next one. Chris earned $70,000 in 2017. According to that year's tax brackets, he's paid 10% on the first $9,325, 15% on every dollar between $9,325 and $37,950, and 25% on every dollar between $37,950 and $70,000. He estimates his total tax liability at $13,238.5, which would make his average tax rate 18.9% before accounting for deductions that could lower his actual taxable income. A proportional tax is an income tax system that levies the same percentage tax to everyone, regardless of income. A proportional tax is the same for low, middle, and high income taxpayers. Proportional taxes are sometimes referred to as flat rates. A regressive tax is a decreasing average tax rate as income increases. Low income individuals pay a higher amount of taxes compared to higher income earners under a regressive tax system. That's because the government accesses tax as a percentage of the value of the asset a taxpayer purchases or owns. This type of tax has no correlation with individual earnings or income level. Effects of income tax. Income tax is a tax on sellers of the services of labor, capital, and land. The incidence and inefficiency of a tax depend on the elasticity of demand and supply. Effects of tax on labor income. Figure shows the demand curve LD and the supply curve LS in a competitive labor market. The demand for labor is elastic since firms can substitute machines for labor in many tasks. But supply of labor is inelastic because most people have few options other than to work for their income. In this example, with no income tax, workers would earn $19 an hour and work 40 hours a week. With a 20% income tax, the labor supply curve shifts to LS plus tax. If workers are willing to supply the 40 a week for $19 with no tax, then with a $20% tax, they're willing to supply the 40th hour only if the wage is $23.75 an hour. That is, they want to get the $19 they received before plus 4.75, 20% of 23.75 that they now must pay to the government. The equilibrium wage rises $20 an hour, but after tax wage rate falls to $16 an hour, the tax $4 an hour. Employment decreases to 35 hours a week. The workers pay most of the tax, that is $3 compared to the $1 the employer pays. Because the demand for labor is elastic and the supply of labor is inelastic, the tax creates a deadweight law shown by the gray triangle. Tax on capital income. Capital income in the form of interest on bonds and bank deposits is taxed at the normal income tax rate. But capital income in the form of dividends on stocks is taxed twice. It is taxed as a dividend at 15% and it is taxed as corporate profit at the corporation income tax rate. Figure shows the demand curve KD and the supply curve KS in a competitive capital market. Because many tasks can be done by machines or labor, the demand for capital is elastic. Capital is internationally mobile and its supply is highly elastic. In this example, firms can obtain all the capital they wish at an interest rate of 6% a year. So the supply of capital is perfectly elastic. With no capital income tax, firms use $40 billion worth of capital. With a 40% tax on capital income, the supply curve shifts to KS plus tax. Lenders want to receive an additional 4% interest to pay their capital income tax and are not willing to lend for less than 10% a year. With the capital income tax, the quantity of capital decreases to $20 billion and the interest rate rises to 10% a year. Firms pay the entire capital income tax and the lenders receive the same after-tax interest rate as they receive in the absence of capital income tax. The tax creates a deadweight law shown by the gray triangle. Tax on the income from land and other unique resources. Each plot of land and reserve of mineral or other natural resources is unique, so it's perfectly inelastic. A fixed amount of the resource is supplied regardless of the rent offered for its use. The figure illustrates a tax on land income. In this example, a fixed 250 billion acres is supplied regardless of the rent. The equilibrium quantity is determined purely by supply and the equilibrium rent is determined by the demand for land. In this example, the equilibrium rent is $1,000 an acre. When a 40% tax is imposed on rent income, landowners pay all of the tax. Their after-tax income falls to $600 an acre. This tax is efficient because the equilibrium quantity of land used is the same with the tax as without it. The economy generates no deadweight loss or excess burden and is ideal from the perspective of efficiency. Figure B illustrates this case. Suppose that Bradley Cooper is willing to make an average of 3 movies per year. His supply of services is perfectly inelastic at that quantity. Hollywood studios compete for his services, and the demand curve reflects their willingness to pay for them. The equilibrium price is $20 million per movie. If Bradley pays a 40% tax on this income, he receives an after-tax income of $12 million per movie. Bradley pays the entire tax. The price paid by the studios is unaffected by this tax, and Bradley makes the same number of movies with the tax as without it. This tax creates no deadweight or excess burden. Social Security tax. The incidence of Social Security tax, like the other taxes, depend on the elasticities of supply and demand in the labor market and not on the wishes of the Congress. In this example, first the tax is imposed on workers, then on employers. At Social Security tax on workers, the figure shows the effects of Social Security tax when the law says that workers must pay the entire tax. The Social Security tax on employers. With no tax, 4,000 people are employed at a wage rate of $12 an hour. A tax on employers is $2.50 an hour, which shifts the demand curve leftward to LD tax. The quantity of labor employed on demand for labor decreases to 3,000 workers. Because firms must pay $2.50 an hour to the government, they will hire 4,000 people at a rate of $12 minus $2.50, which is $9.50 an hour. Employers' total cost of labor rises to $12.50 an hour after tax, the wage rate of $10 an hour plus $2.50 an hour tax. The government collects tax revenue shown by the purple rectangle.